Okay, I think I'm going to go ahead and get started. Hope you're all doing well. And for any of you that are playing out in this real estate market, I hope you're surviving. It's pretty wild out there, that's for sure. This is February's SJREI. We're here with Carl, and we're going to talk a little bit about what's going on in the marketplace, and then we're going to hear from Carl about how to protect yourself. And I will share a little bit of something that I thought was interesting. I was conversing with one of my friends a few years ago, and he was a vice president of a very large company. And he was telling me how about 25% of their budget was set aside for legal, for lawsuits, representation. And I thought that that was interesting. And then it dawned on me that, you know, in this day and age, it's not if you get sued, it's not if you get yourself into trouble, it's when. And are you set up in time? Are you set up before it happens? And so that is why we are honored to have Carl come back and speak with us and share the things that you need to know, not to just be protected, but to be protected and still be able to operate a business. Carl comes to us, and I'll get into this more later, as an investor and as an attorney. So I'm very honored to have him here today. So this is SJREI. And we are where the deals happen. You can ask me anything real estate. So we're here offering education. We encourage you to do your own due diligence. We don't necessarily endorse anybody. We encourage you to do your own due diligence on all of our speakers. Our goal is to provide education, networking, and opportunities where you can make profitable investments. And the reason we say we're where the deals happen is when we polled our audience, we found that over 78% of our regular attendees have done business together because of and in the relationship of SJREI. So I want to jump in a little bit about the economy, because since the last time we talked, we've seen things like in the stock market just go, if you've been in cryptocurrency, you saw that. There's some pullbacks. We now know that the inflation is not transitory. It's here. It's real. And we also know that we're going to see some rate hikes come into the marketplace. If you've been around SJREI at all, you know that Bruce Norris talks about an affordability index. And he says often that rate hikes don't necessarily stop the market. There's usually an accelerant before it stops. So as we start to see these rate hikes, you're probably going to see prices in the marketplace continue to grow because everybody is racing to pull the trigger that maybe they were sitting on the sideline. And with our inventories as low as they are, this is going to get crazy. Add to that the fact that most likely worldwide, the COVID is coming to an end. Our war on COVID is over, and people are going to be free, mask free, vaccination free, whatever the choice is. It's happening country after country, including our country. You're going to see some expansion in our economy, like it's basically going to be an accelerant. It's probably going to take off for a while, but then the metrics aren't there, and we will see it pull back. So we're going to encourage you as investors to be aware of what's going on and not get caught up in that feeding frenzy. So I went out and I listened to a bunch of YouTube. If you're not, spending time in YouTube, you probably should. There's so much information out there. And I found a couple interviews with Robert Kiyosaki. And so tonight is in honor to Robert Kiyosaki because I liked some of the things that he said, and I thought, all right, let's just share this. So the first thing, you know how he can be kind of bold, and he just goes out there and he says, savers are losers. Yeah, he just is like so frank. with his marine attitude. But you know what? He's right in kind of two ways, right? If you are trying to save money in an inflationary period, you are losing money. So in a sense, savers are losers. And so that's a pun on words. I thought that was a really good one, and maybe it'll stick with you when you think about saving. The other thing he said is inflation rips poor people off. Inflation makes the rich get richer. And if you look at the bigs out there, the bigs keep getting bigger. The middle class is getting torn apart. So we have the haves and the have-nots. And inflation is going to make that even more noticeable. So when he was asked, what do you invest in? So he said you invest in gold, silver, Bitcoin, and real estate. Now, you might think, okay, it kind of sounds a little, but his reasoning kind of makes sense. So he goes into why gold and silver, because they're created by God, meaning the government can't print more. They can't make it inflationary. It's just gold, and how much there is, there is. And the same thing with Bitcoin. He likes the fact that it's decentralized, that it's not controlled by a government, and that the quantity is controlled. It's not being created more and more of them. Now, it's interesting when you look into these, he's actively out there buying them and investing in it. And so he's putting his money where his mouth is. And then when you go into real estate, there's a couple key components here. You have leverage with fixed debt. So if you're borrowing today, let's say 3.5%, and the inflation is 7%, essentially you're getting paid to borrow. And so when you're making those payments back, it's with cheaper dollars. In addition, if you're buying properties that have covered debt, meaning they have income on it, most of the time, most of them have inflation adjusted income that's coming in. So you have debt that's, staying fixed. When inflation's going, you have income that's adjusted. And then a lot of times you have demand that's forcing appreciation in areas. And then there's the tax advantages. Now, one of the things that I found very interesting is he calls it the shadow economy is how he refers to it. Right now, the US dollar is the currency, the world currency for like oil. And when you go to buy it, like if you're in Europe and you pay something in a US dollar, most of the time people are holding on to that dollar. But what's happening in the shadow economy now, like in the European markets, China, they don't want the dollar anymore. They're not holding the dollar. And so this shadow economy is already going for other assets other than the US dollar, which is something that we don't often hear about because that's, our country's currency. But it's important to be paying attention to that because at some point there may be a reset. And with that reset, you need something other than the dollar, which is why he's into gold, silver, Bitcoin, and housing. When he talks about real estate, he's mostly referring to housing because people need places to live. And so that's what he's doing. Now, the key is for him, it has to be covered debt. I was listening to another gentleman and there was a podcast, there was two of them. They were bragging about how much debt they were racing out to get. Like a lot of times as middle class, we're not thinking debt. We're thinking, let's pay it off. And here they are out racing to get more debt. And it's mostly because they understand this piece here. But the word that they kept using that I think is important to understand is covered debt. They were making sure that the income was covering the debt so that they would not default on that. So if we look at the type of housing that he's talking about, short-term housing, short-term rentals, and part of that is that he sees this economy moving to the place where everybody is going from place to place. Like maybe you don't have to work in an office anymore, so you spend 3 months here and then you go somewhere else 3 months, and so he sees that as a long-term trend. Additionally, he sees long-term housing like apartment buildings and regular houses in nice neighborhoods. A couple of the other people that I listen to are talking about this shift. We're moving from a shift of homeowners back into renters, and there's going to be more renters, especially if we hit the recession. So definitely housing. Legacy type properties, mountain properties, lake properties, beachfront properties, things that aren't going to be, that aren't being made anymore. He talked about assisted living and the whole tsunami, the silver tsunami that's talked about that's coming. And he was very clear, stay away from retail and stay away from offices. Another trend that I am reading about and seeing is warehouses, with Amazon setting up these last mile routes. They're selling routes to individuals where you're taking the goods for the last mile. So they're having these warehouses where they drop everything and then the routes take it out. Well, not only is that a trend where there's going to be a need for more warehouses because our retail is moving to just be delivered to us, buy it online, get it delivered. Another thing that we're starting to see is restaurants sort of doing the same thing. There's a couple firms that have started taking these warehouses and basically breaking them up into different kitchens. So let's just say you have a Taco Bell kitchen and you have, Hardee's, or not Hardee's, Carl Jr. There we go, Carl Jr. kitchen. They don't need to have a space for customers to come in because you're ordering on DoorDash and Grubhub. So in these warehouses, they're setting up these kitchens, these industrial kitchens, where the food is being made and then it's being picked up and delivered to you. So there's a lot less space that's needed. So they're getting by in, 12 by 15 foot kitchens and getting a lot more of the kitchens all in one spot, almost like I don't know if you've been to a hair salon where they have all these little offices for the beauticians. It's the same thing for these kitchens. So these are the directions things are going, and we need to pay attention to that as you're making the investments. So I just wanted to share that with you. I hope you found that valuable. And I think that's it there. As you know, we're doing deals. We're always doing deals, right? And I have about 5 or 6 deals in the pipeline right now. And this is one that I'm super excited about. So I mentioned Bruce Norris before. And as many of you know, Bruce has permanently relocated out of the state of California to Florida. And he is offering opportunities for you to buy investment properties in Florida. So I started spending some time looking at the statistics and the metrics in Florida, and it really is a good market, in my opinion. Okay, do your own research to make investments in. So one of the areas that I was looking at, kind of taking the Robert Kiyosaki legacy property, was St. Petersburg. And I found this one property. I've been watching the market there for about a year now. And this one property came up here. You'll see it with the red arrow. Now this is in St. Petersburg. This is Sweden Island here. This particular property has deep water access right out to Tampa Bay. No bridges, nothing. And it's a beautiful area. Normally the houses, like you can see this one large house here, normally these houses sell for about $2 million to $3.5 million. They're pretty expensive in this area. This particular house is the ugly duckling. It was originally there was a house there, it burned down. So a custom house was built in 2004. Now this custom house has got no curb appeal whatsoever. The decks have not been properly finished, and so they're just about rotting off and unsafe to go up. They left the old garage that was there. And so this is an opportunity to acquire this type of legacy property for a very reasonable price. So again, most of these homes are in the 2.5 to 3 million price. This house is over here at the end. And I was able to get it in contract for 1.25. It is going to need some rehab. You know that's my thing. I go in and I rehab. Once it's rehabbed, low end, it's going to be worth 2.1 million. So if you're interested in partnering with me on this, please don't hesitate. Send me the email immediately, because I'm moving forward on this, and I'm looking for 1 to 2 partners to move forward with me on this also. The goal is to get in there, rehab it. I will refinance your money out. If you want to stay in the deal long term with me, we can discuss that. But basically, this is a legacy property that we're going to create value, do a BRRR with short-term rental on. So that's what we're doing with that. Okay. And with no further ado, I'm going to stop my share and let Carl get his up. So as I mentioned, Carl comes to us as an investor and an attorney, and he's going to talk to you about how to protect your business, your assets, and how to run your business without being constricted. So thank you, everyone.
Absolutely, and thank you so much for the kind introduction. Yeah, my name's Carl Zoellner. I am an attorney. I know I'm speaking to a group in California, so please hold your booze to the end. We're going to talk a little bit about tax and asset protection. Just as a reasonable standard here, I don't think anybody expects that I can teach you everything there is to know about tax and asset protection in the short time we have with each other. What I'm going to do is plan to make the presentation right around about an hour, and then we'll leave some room at the end for some questions as well. So you can ask them along the way. The way my screen is currently set up, I probably won't see them to the end, but you're more than welcome to enter them in there. And then we will go through some of those at the end, and we'll get you the answers hopefully you're looking for, but I'll give you the answers either way. So a little bit about the company I work for, Anderson Business Advisors. There are probably several of you who are familiar with us, but if you're not, at our core, we are a premier education company that employs professionals like myself to teach and execute the strategies we implement for ourselves. So as Lori mentioned, I am an investor. I do cryptocurrency, stock trading, real estate, and pretty much anything else that'll make me some money. So probably like a lot of you, I try to do many things and sort of become an expert on those things. I would say a unique twist on what we do is, since we have attorneys and CPAs who most, if not all of them, are all investors, it causes us to look a little bit more closely too, because we want to minimize the impact on our tax returns, as well as protect ourselves from liability between our investments, as well as from our personal and business perspective as well. So one thing a lot of folks or a lot of investors I've met with don't think a ton about is, I think when you have a rental property, the idea that a lawsuit could come from a tenant makes sense. One of the things that is usually a little bit of a struggle to connect the dots on is, it's not only, and we refer to that as inside liability, it's not only the inside liability that can cause you an issue, but also outside. If you have a spouse or you have kiddos, God forbid one of you gets in a car accident, if you're owning things in your own name, then those are personal assets subject to that type of judgment. So we also need to look at the outside liability, which is especially important when we start talking about brokerage accounts, if you have a cryptocurrency wallet, things like that. Now, a lot of people will be cute and tell you, with your cryptocurrency wallet, well, nobody will know about it. Okay, but if they do know about it, or if you are subject to a judgment and you don't disclose it, then basically what can happen is a judge can toss you in the slammer until you choose to produce that. So it's one of those things. There's ways to protect those or separate them from your personal assets. So it's something we need to think about. Like I said, sort of the outside liability tends to be the open area, especially with investors, because they're thinking so much about their investment or the liability that comes along with their investment. They're not sort of keeping an eye out for what kind of issues they may be bringing to the investment. So we need to look at that too. Who do we serve? We serve investors and small business owners all over the country that are investing in any of the 50 states. We do have, I mean, certainly, I guess more accurately, we work with people who invest in any of the 50 states. We do work from time to time with foreign investors. However, the foreign piece of your tax situation would need to be addressed with the foreign country or a tax professional in that foreign jurisdiction. Same thing with foreign assets. So if you've got, properties in China or India or Europe or, sort of other places, we have our hands full with the United States and the differences between the 50 states. So we would encourage you to at least work on if you own foreign assets, to work with a local professional there to help you get situated with protection in those areas. Like I said, about me a little bit, like I said, number one is love to teach. Those of you may have seen me a year ago or a couple years ago. I think it was 2017 or 2018 when Clint and I came in person and met with folks too. But we love to teach. It's one of our favorite things. And quite frankly, our model is to sort of give the education away so that everybody is informed. As I mentioned, my day job, attorney, outside of my day job, I am an investor like all of you in those different areas. And also, just as a quick comment on Lori's piece there, yeah, as inflation goes up, fixed assets tend to do better, because if I buy a house at let's say $200,000, which I know is, sort of a cute concept for California, but if I buy a house for $200,000 and the price of a dollar goes down, then chances are there's going to be quite a bit of appreciation there in the property. Same thing with those like gold and silver. So I don't know. Real estate's always been more appealing to me than gold and silver. I did own gold at one time. And those of you who have not had that pleasure yet, tends to be a little bit of a kick in the shorts, because you're paying spot price on the front end, and then they charge you a fee against the price on the back end. So yeah, it sort of works when they talk about this. I mean, nothing wrong with it. For me, it was too long of a hold to see anything. And it's not like you can refinance your gold. So something to consider there too. But yeah, fixed assets tend to do well in inflationary periods, because as the dollar becomes less, it takes more dollars to buy the thing you bought for less dollars. So it's a good deal. I've even looked at things just currently with my family we built a new house in Utah, and I'm doing solar on it. And the interest rate is lower than the inflation rate. So I'm letting the lender hold the bag, and their money can be worth less. So like I said, lots of cool things you can do with real estate. If you can't, one quote I really like is from a pretty smart guy named Albert Einstein. If you can't explain it simply, you do not understand it well enough. Okay. You probably have already guessed it from hearing me start to speak and introduce myself. I am not going to drown you with things like anticipatory repudiations and things like that. It doesn't help me and it doesn't help you. So I'm going to speak as plainly as possible. My first illustration here is to help illustrate a basic concept or something that we're going to look at. We're going to look at investing through a couple different lenses. So these are the old school 3D glasses, right? The ones you used to be able to pull out of a box of cereal, not the $1,000 ones that actually make you think you're fighting bees or make you run into your wall. So first concept is we're going to look at the liability side, or liability protection, when it comes to investing in assets. So first big concept, pretty straightforward. You don't know what you don't know, right? I mean, this is the reason you come to this class and work with Lori and get this education, is because you're the group that's smart enough to know you don't know what you don't know. Also, I would just say, from being in San Jose and working with San Jose clients long enough, I'm sure there's some doctors out there So just like there are Google doctors, there are Google attorneys, and they know just as much. So be aware of that. It pays to work with somebody who's experienced, been where you've been or trying to get to, so that they can help show you the path. A good little, I guess, a mental picture, it would be a minefield, right? I don't need to know where every mine is in a minefield to get across it. I just need to know the path where there's not mines so I can make it safely across. Same thing. Through our Platinum program, some of you may be Platinum clients already. We work with over 40,000 clients over all 50 states. So we see a ton from different strange and odd little issues that pop up, whether that's on acquisition or disposition of property, working with partners, things like that. They all have their own little nooks and crannies that can be a bit of a headache or slow things down along the way. And for most folks out there, especially those who are familiar with rehabbing properties, time is most certainly money. So if you can put some of those things aside or find creative solutions around them, usually pays dividends for you. So we're going to help you know what you don't know, or if you have those questions, you can certainly reach out. One of the interesting concepts of Anderson Advisors as a law firm is we don't charge an hourly rate. We have enough clients that we can provide advice to our clients for the whopping cost of $35 a month, because it kind of works like a gym membership. There's a ton of folks paying into a system to have access to our professionals. So it allows us to charge a lower rate versus you calling me up in a frantic panic because something's happened and then me charging the bejesus out of you to make you feel a little bit better. So we work on the preventative medicine side of things because it's more reasonable in cost, and it actually incentivizes you to work with us on the front end versus having to call an attorney on the back end for that sort of emergency help, which is always way more expensive. So we can talk about rates. So normally rates would be as if we had our, a brick and mortar shop in California and did this. You're probably looking for, for myself, somewhere around $750 an hour, for one of the partners, north of $1,300 an hour for advice. But like I said, we believe in giving the education away and helping you execute these type of strategies because we invest in our employees as far as attorneys and CPAs and things like that. So we want to extend that to you. And realistically, the whole business concept came from getting bounced between our the CPAs and attorneys, because most times CPAs will comment on tax, but not liability protection. And most attorneys will comment on liability protection, but not tax. So usually what you end up with is the default of like an LLC taxed as an S corporation, which by itself isn't a bad thing, but it's not the right fit for everybody. And it tends to be sort of a default, or you've done enough Googling to think you got it figured out, right? Easy to run an LLC, but I want the S-Corp taxation. Why? Because Google told me so. So we want to do a little bit more careful planning on that. And it's incredibly important to have a tailored structure for you. I can't tell you how many California clients I've worked with, probably hundreds, if not thousands at this point, but very small differences in your goals or how you choose to invest or what your, say, preference is as far as franchise tax, things like that, can have your structure vary greatly, or drastic differences. So things that may seem small are not, especially in California, as you can imagine, especially as all of y'all have probably started to get your feet wet. You can kind of tell California is a bear when it comes to taxes. It is. Everybody's got their hands in your pockets, and you've got to be creative to work your way around it. And there's some different things, and we'll talk about this in a little bit too, but some different strategies out there that can help you with it. Now, from getting a little bit of knowledge on knowing what you don't know here, some of our main tools are going to be a traditional corporation. So they are distinct ownership from you as an individual, and also avoids dealer status. Dealer status is important if you're doing investing or doing things that create dealer activity. So things like rehab and sell, that's dealer activity. Wholesaling, dealer activity. Property development with the intent to sell those properties, dealer issues. Problem with dealer status is, it actually sounds kind of cool. It's not. So the problem with dealer status is you lose out on things on the investment side, like no more 1031 exchanges, no more long-term capital gains, no more installment sales. So if you're doing some seller financing or doing, like I say, an installment sale, you can technically still do it, but the entire taxable income is taxable at the moment you sell it instead of over time, like if you were not a dealer. So there can create some issues being a dealer. Basic concept, you don't want to be a dealer, okay? LLCs are also distinct from the owner, so it creates separation between the individual and your business. You have a choice of taxation. With a corporation, you get to choose. It starts out as a C. You have the ability to elect an S corporation status. In an LLC, you can choose to be if it's a single member, its default is a disregarded or sole proprietorship taxation. If it's two members, its default is a partnership. And you also have a choice of taxing that LLC as a C or S corporation. They're more flexible and less formalities than a traditional corporation. But anybody who has scared you away from a traditional corporation to use an LLC taxed as a corporation, the significant difference is basically 2 very short meetings a year. So it's nothing to be scared of from that perspective. One more that didn't make this slide that I just want to touch on is a limited partnership, which can have its place in California as well, just due to the franchise fee that you can take, that you can be subject to depending on the value of a property. Most commonly, it's important for those who are doing those rehabs. If you're rehabbing more expensive properties, it's a nasty little fee that gets tagged on with LLCs. And the reason it's nasty is because it's a gross receipts tax. It is not a net tax on the net of what you sell it for. So you may see us use limited partnerships there because it's capped. So there's a minimum with LLCs, it's 800. LPs, it's capped at 800. So depending on like I say, the price of the flip, probably use an LP there. So it's at least capped. You don't get to avoid the whole thing, but ultimately it's a better solution, especially if you're, investing or doing a flip in the San Jose area, or, you've especially dealt with it quite a bit in, say, the San Francisco area, those type of things where, costs $1 million to buy a tent off a homeless person on the street. Those are the times we look at those things because it can add up, it can stack up quick. So like I said, limited partnership is also distinct from the owner. The downside, or the risk side of a limited partnership, is usually the general partner has unlimited liability. Normally, the way we work with that is by having an entity that does not hold a lot of assets directly be that general partner. So if something happens, the entity gets sued, the general partner, in a worst case scenario, doesn't really own anything. So the unlimited liability doesn't mean a whole lot. Let's talk about here. Next big concept. We want to use the right tool for the job. So we talked a little bit about LLCs and corporations. One thing that is pretty common in California, especially for a lot of our clients, is going to be different types of trusts. The reason we tend to like trusts in California is because trusts are not subject to the franchise tax. And the franchise tax is one of those things that, I sort of go back and forth on this. So some of it is going to be the cost of doing business in California. You're a California resident. California defines doing business differently than any other state in the United States. So I'm sure none of this is overly shocking to all of you as California residents, but just so you know, depending on your scenario, I may still suggest having a California LLC if you're not doing a ton. It may just be the cost of doing business. And for your sanity, it may be worth that $800 a year to do that if it's appropriate. Figured it out at one time, and I'm actually going to do the math here. So 800, realistically, if it's a cash flowing property and it's $800 a year, that comes out to $66 a month to have something that'll work fine in the state. So what does that mean to most investors? It means somebody's paying $66 more in rent every month to cover that cost. So I know the market's competitive. People want to look at different items. I'm not saying that's going to be the case for everybody, but there is sometimes I've worked with California investors, and sometimes it's sort of amazing. Like there may be I'm working with somebody who's got $40 million in assets, and they're upset because there's one California LLC they've got to pay $800 a year for in the state of California. So there are solutions out there, but we also want to provide you with the practical solutions for them, because if I create something you can't use, it's not super helpful for you. Or if you don't understand it and you start disclosing all the things that you thought you had anonymity on, you're not getting a ton of benefit out of it. So we want to make sure the fit is right for you. And that's why you need that individualized, or sort of, for lack of a better term, bespoke asset structure for you, because it's going to be different for everybody. Now, trusts and investing solve problems. Okay. So a lot of times, so land trust, number one, we like to use quite a bit. They're a grantor trust. They're a tool, depending on what state you're investing in. If there's transfer tax, usually a land trust has an exemption for that because it's a grantor trust. It also can help fight back or provide a deterrent to lenders for accelerating a mortgage. A lot of people usually have questions about due on sale, or how do they transfer a property into an LLC or a trust. To be frank, most times, as long as the mortgage is current, the lender doesn't care. Lenders are in the lending business. They don't want to own your property and pay for maintenance on it until somebody comes out and gives them a lowball offer to purchase it. They'd rather you pay on your loan. So most times, as long as your mortgage is current, it's not a big issue to transfer that property. Even most recently, Freddie and Fannie guidelines have allowed for the transfer of a property into an LLC that's owned by the same taxpayer. So even the, lenders sort of move at the speed of an iceberg a lot of times. And even they're starting to come along down the track in order to comply with the realities of investing and working with people who are, faithfully paying on their loans or mortgages. The land trust can also provide an additional layer of anonymity. So when you title a property in the name of a land trust, what shows up is the name of the trustee, as well as the name of the trust, and usually the date the trust was established. So what that looks like is, say if I owned a property in my own name, and be Carl Zoellner as a married man, is the owner of XYZ property. If I'm using a land trust, I can use a nominee trustee. So in this case, I will use one of the founding partners of Anderson as my nominee trustee, and use Clint Coons. It would show up as Clint Coons as trustee of, we'll just call it 123 Main Street Trust, dated, February 10th of 2021. That's how it would show up. So it's still my property. I still have control over it. I'm still getting all the rental income, but my name no longer shows up on it. So if somebody or a plaintiff's attorney gets a wild hair and wants to start looking at what assets I own, doesn't show up there. Commonly as well, it's used for, say, if you have a personal residence, you'd like for them, for a potential plaintiff attorney not to see. Works well there. I have a specific client story I'm thinking of. They had a property in Newport Beach, had a, lack of a better term, crappy little rental someplace. Attorney saw the rental was in the person's individual name, did an asset search, saw the house in Newport Beach, and what probably would have been a insurance settlement for the rental property deal. The attorney took that person with the house in Newport Beach to the cleaners, and the person ended up selling the Newport Beach house, and it was, I don't know, it was uglier than it had to be. The idea is pretty simple. Our aim is actually not to just provide you the best asset protection should you get sued, but actually to remove the motivation for people to come after you. If we can sort of take away the pot of gold at the end of the rainbow, then it makes it less appealing for an attorney to shake you down. Concept's pretty simple, right? I am an attorney. If I'm an attorney and I see that you have 20 properties or a couple high price properties, plus the one that had something that happened on it, do you think I'm willing to settle for less than if I couldn't see any of the things you own? Because what you're doing is it's a business concept. You're creating risk on the side of the attorney, right? If I'm taking this case on contingency, which means I'm just getting paid a percentage of the judgment when it finishes, if I can't see or have a high likelihood of knowing what I'm going to get at the end, then I'm probably not willing to be as bold or front as much money to pursue something just in a hope that it's there to pick, sort of grab it at the end. I like grilled cheese and all, but I'm not looking to live in a studio apartment and make grilled cheese with my, on my ironing board for chasing down things that I hope are there. So, like I said, pretty straightforward, but it really does take a look at that strategy of, we want to remove the idea that you are somehow a valuable target to go after. Okay. Now that doesn't mean you got to drive, an 87 Bug and live in squalor or something. But I'll just tell you, as a group, attorneys are notoriously lazy. So if you take away the low-hanging fruit, they're more likely to go after your, investing friend who was giving you all sorts of tax and legal advice and DIY'd it on, LegalDoom or InkFile or something like that because they didn't do it right. And now the attorney can see what they have. So it's, I guess, an older timey saying is, the bird in the hand is worth two in the bush kind of a thing. And from a business perspective, I'll tell you, as an attorney, if I hung my own shingle and was going after you, I would go after the guaranteed wins first before I put out a huge level of risk, because risk can basically mean losing money to an attorney if they're footing the bill for litigation until they see the results, or until they get their portion. So just as a good concept there. Personal property trust. This one can be a little bit confusing because the name, a lot of people think it's for like their personal residence, or I guess most people think it's for their personal residence. It's actually not. So we see the land trust. Land trust is really meant for real estate or real property. Personal property trust is basically everything else. So I can use a personal property trust to own my membership interest in an LLC. It can hold my corporate shares. It can do pretty much hold anything that a land trust is not intended for. So anything that's not real property. Where do we use these? Tends to be more common with traders who are day trading and need live data feeds. A lot of time, number one is you should have your trading account or a brokerage account in an LLC. Most times you don't need the PPT, but there's cases where it works if you're working with the brokerage houses are now, you can't swing a cat without hitting a new brokerage house every week. So it's basically, if there's a brokerage house trying to charge you professional fees for your live data feeds because you want that brokerage account held in an LLC, a personal property trust tends to resolve that issue. So that's where I would say I use it most commonly. The other place I use it is if you have existing business entities and are looking for a level of anonymity, we can switch the ownership from you as an individual to a personal property trust. And that way, when you look it up on the Secretary of State, the owner looks different. So it's like I said, sort of another good little workaround there. The last one on there is a living trust. And basically the best part of a living trust is it avoids probate. In California, last time I looked, I believe the statutory probate fees start at 8% of your gross estate. So if you can avoid that, that would be great. Also, if you have properties in multiple states, your living trust is the only tool that will help you avoid probate in multiple states. So just to reiterate here, if you have a will or no estate plan at all, your estate will be forced to probate in every state you have assets. So I can think of several people who have actually, where the cost of probate was more expensive than the property that they were trying to probate and inherit. So usually what that means is they allow the property to go back to the state, so because the cost of probate's too high. And it happens all the time. That's how usually the state ends up getting most of their property, is because probate's too expensive. So they let it, what's technical term is let it escheat back to the state, and then they sell it. So just an FYI there. All right, so let's take a look at some examples here. So this is just an example of say you bought some Indiana properties. The LT in the green box is land trust. The blue box we haven't introduced yet. That is a Wyoming LLC. You will hear when you visit our YouTube channels, things like this, you'll hear us reference a holding company. That's what this Wyoming LLC is. This Wyoming LLC, we choose Wyoming because basically all the 50 states, Wyoming and Nevada have the best combination of, they got a few things: business courts, asset protection, as well as anonymity. They're the best combinations. They're usually tied for one. We tend to use Wyoming because Wyoming is more cost effective to maintain. So where Nevada is now, I think, somewhere in the range of $750 a year, Wyoming is $50 a year. So that's why we use Wyoming, and that's why we use it as sort of the investing hub, so that you have a safe and anonymous place you can pull that income to, and it's not just sitting in your savings account. So from your point of view, this is what you would see. You know everything, you control everything. So you've got this scenario, you'd have 3 rental properties in Indiana. 2 of them we got in land trusts. The beneficiary of those land trusts is the Indiana LLC. So when it comes to land trusts or grantor trusts, the protection afforded to the assets inside those trusts depends on who the beneficiary is. In this case, it would be an LLC. So it's got the same protections as if it was this middle one that has no land trust. So that's the scenario from your point of view. Now, we talked about inside and outside liability. Inside liability is something that happens inside one of those red boxes, right? So let's say there was an inside liability issue. Let's say there was a slip and fall in this red box. So same structure. We just had an issue inside here. So what does a plaintiff attorney see? So first thing is somebody gets injured, they want to sue you. First thing the attorney looks up is who owns that property. In this case, it's the Indiana LLC. So when I've looked up that the Indiana LLC holds title to the property, where do I go next? Well, I go to the Secretary of State website to see who owns that Indiana LLC. When I go to that Secretary of State website, I see the name of the Wyoming LLC. Okay. Now, here's where the anonymity comes in for Wyoming. When I look at the Wyoming LLC, Wyoming does not require us to list a member or a manager. So how does it work when Anderson sets it up? They do require somebody to be listed as an organizer. And from our perspective, it's going to be one of our employees who's listed as organizer. So they can't draw the line to you. Okay. So if something happens, if something happens in that Indiana LLC, that's the extent of what they can see. They can't see you as an individual. If you look down here, they also can't see your other properties. So that is the sort of power from inside liability. It gets even better if it's an outside liability issue. So say in that, circumstance, I hope doesn't happen to anybody, but say, spouse or kiddos get in a car accident. This is all from an outside perspective you would see, right? Because the individual who got in the car accident because you exchanged insurance or whatever. But now as an attorney, I can't see any of your investments because of that Wyoming shield. So using these layers of anonymity and asset protection is how you put this picture together. One is if something happens on the inside, you sort of only know what you're interacting with, but you can't see anything else. So it limits the scope of what an attorney can see. From the outside, you really can't see anything at all from an investment standpoint. You just see an individual. So that's when we start, like I say, when it becomes valuable to have that personal residence in a land trust, so you can't see it from the outside if it's a valuable property with lots of equity. Now, the other neat thing is, I know with property tax reassessments, things in that, there's always questions of that nature. Grantor trusts do not trigger that reassessment. So whether it's a land trust or your living trust, if you put assets in there, as long as the ownership is the same, there is no reassessment on the property. So good news there. Okay, so our next lens here is our taxation lens, okay? I know, especially important to California folks, right? So first big concept on tax is failing to plan is planning to fail. Tax planning is not dumping a box of receipts off at your CPA. That's not where the planning happens. Planning happens throughout the year, preferably quarterly, so you can take a look at your tax situation and make sure you're hitting the landmarks you want to, so you're in the place you want to be at the end of the year, okay? So I guess that first concept, there's a fancy saying, but really it's understanding the difference between tax prep, tax planning. As a piece of that as well, I will tell you, having a good bookkeeper or having some sort of bookkeeping in place will save you money. Yes, it'll cost money for the bookkeeper or bookkeeping service, but you're saving CPA time, because a lot of times if you're dropping those receipts off to your CPA, they're still charging you CPA rates to do bookkeeping work. It's not like they're, dropping the rates down for you to help you sort through your, shoebox of receipts. So bookkeeping is a big part of what we would say is a good piece of your overall tax planning structure. Now, some common tax and business issues, like I mentioned, lack of planning tends to be one of the main ones. Also wrong taxation. So overpayment in taxes is also likely to eat into your profit margins as well. If you didn't sort of sit down and have that conversation and somebody looked at your specific situation. Like I said, a lot of CPAs out there will just simply put you into some sort of S-Corp taxation, but it may not necessarily be the right fit given your overall plan for your business. Another piece as well is lendability. If you're looking to be lendable, most times if you have some sort of entity with corporate tax status, you would want that to be a C corporation because of what the lender can see. So with an S corporation, the big difference is you'll have your annual tax return that comes out of the S corporation, which is 1120S, and you'll also have a K1 that's generated, which when a lender asks for that information, shows them that you own that corporation. Now, the functional piece of that is the lender then wants to look into your corporation. If you have a corporation set up to do real estate, a lot of times that corporation is sort of a tax catch-all. So it's not going to show up as super lendable, which can cause problems with lendability. Now, in a C corporation, the difference is C corporation files an 1120 and does not have a K1. So it does not put the lender on notice that you own that corporation. Now, from a functional aspect, I'll tell you from experience, you are just as likely to screw up an S corporation as a C corporation. It's literally about your financial capabilities or situation within that corporation that tends to make the C corporation a better option from a lendability standpoint, because if you're paying yourself out of that corporation, it just looks like you're getting a W-2 from a business. S corporation, that K1 sort of triggers them to dig deeper to look at the business. So just as a FYI or a tidbit there. Now, we talked about the structure from a lendability standpoint, or excuse me, from a asset protection standpoint of, what a potential plaintiff would see from an inside perspective, outside perspective, and also what you see, knowing all the pieces. From an IRS perspective, that same structure, let me just pull it back up again. So that's the structure you see. From an IRS perspective, this is what the IRS would see, okay? They would be looking for a corporate tax return. They would be looking for an individual return. The question's pretty much always asked when people see this is, oh my goodness, how many tax returns am I going to have? Well, if you're the owner of all three of those properties, then that's probably realistic. Individual return, corporate return. Now, when it comes to that, like I said, it could be a C or S corporation. It takes some analysis to say C or S. What I'll tell you, it tends to be one of the main deciding factors is usually, are you planning to live on most of the income coming into that corporation? Or is it for more investment and tax purposes? And in the case where you plan to live off of it, like a service business, like if I had a law firm and I set it up as an S corporation, I would set up as an S. If it was something like, I don't know, I just set my wife up a C corporation about a year ago because she wasn't going to be doing a ton of income through there, at least we suspect not. But she did have some expenses we wanted to capture, including medical expenses, things like that. That's a great use for a C corporation. So like I said, when you have a corporation involved, the IRS can be looking for that corporate return, be looking for your individual return. If you're partnering with a bunch of people, they will also be looking for a partnership return. So just be aware of that in the process as well. Now, usually that's pretty simple, especially if you're investing with somebody who's doing things like a syndication or taking funds from groups of folks, because usually some point during the year, they just kick out the K1 and you add your K1 to your tax return or have your tax professional do it. So just as a FYI there. Now, some different California considerations that have come up over time. One is that basically, and all of these strategies would basically avoid the franchise tax. So the disregarded limited partnership. This one is a weird one. So disregarded limited partnership basically means a limited partnership setup where the general partner and limited partner are actually the same taxpayer. This technically avoids the franchise tax. Somebody muted me on accident. All right. So usually the weird thing, or the disregarded LP, we think it's going to go away. There was proposed legislation pre-COVID to make it go away. And ultimately, just given California's track record, I suspect it will not be around for too much longer. So it's out there. It's possible. We use it very sparingly at this point, and with the expectation at some point it's going to go away. The Wyoming Statutory Trust. It's a new kid on the block. It is actually it's sort of a halfway between a trust and an LLC. California refers to them or considers them a business trust. So very similar to say like a Delaware statutory trust. Avoids franchise tax. The sort of downside or reality is though, you'll be filed in 2 states. You file in Wyoming as well as California. So the cost of maintenance is a little bit higher because you have 2 states to maintain. You also have 2 states you need to have an active registered agent in. So cost of maintenance is a little bit higher, but it does also avoid the franchise tax. So a good tool, the newer tool for long-term holds in California we tend to use. One of a previous suggestion that still works is also using land trusts and having Wyoming LLCs as beneficiaries. Now, this one is a little bit tough, especially because if you Google it, the FTB has changed its stance. I'll give you some of the history behind it. So in the early 2000s, we actually defended an audit against the franchise board and won. And it was basically the disregarded LLC wasn't subject to the franchise tax. However, over the last, 15 years now, slowly they started to just change their website. And now every time you Google this sort of strategy, it pops up as you owe the franchise tax. So it has become cumbersome to deal with because the internet says so. But technically, we found this works. It doesn't really cause a problem. Really, the problem is, the headaches sort of come in when we're working with other California attorneys or California CPAs who, I guess, use Google as their main source and are sort of down on it. So we've moved more towards the Wyoming Statutory Trust, just frankly, because it's less of a headache. But just so anybody knows, if you're looking for that scenario, the Wyoming Statutory Trust does tend to be a little bit more expensive, but it is a solution out there. So you don't have that $800 a year per LLC in California. So it's a good solution out there. All right. So our process overall is pretty easy. Today we started with a little bit of education. Realistically, our best way for clients to enter and work with Anderson is to start with our tax and asset protection class. When it was in person, it used to be a 3-day class. We've now moved online and it's a 1-day class. So that's basically where your education technically starts. This is sort of a, if you're going to put it close comparison to something you're probably familiar with, this is sort of the pamphlet version of that. It's a little bit of an introduction of those concepts, but really to see how the, masters apply them, you'd want to see our 1-day class where Clint and Toby will also take you through those concepts and show you the structure. One other nice thing about that class is there is significant amount of drawing of different scenarios. So you saw sort of the PowerPoint version with the boxes and stuff, but Clint and Toby will both usually draw up specific scenarios as people view the class. The other thing that's cool is we actually do have our question and answer area manned by attorneys. So you can actually ask questions and interact with the presentation along the way too. So it's been working well for us. So after that first education piece, your next piece is what we refer to as your wealth planning blueprint. So it's that visual depiction of what you're doing or our suggested plan for you, given what you're trying to do from your basically investment perspective. And then after you have that blueprint, we'll want you to continue along with your education with what's referred to as our structure implementation class, which myself and one of the partners will teach. It's basically class 1 is here's entities and trusts, here's why you need them. Structure implementation is now that you've got them, here's how to use them, and here's what we're going to do to help you keep them compliant. Here's what you need to be doing. And then step 3 is called tax wise. So now that you got them, you know how to use them. Here's how to squeeze every penny out of them. So it's a pretty good process that has worked well for Anderson for now 20 something years. So we're going to stick with it because our clients like it and we like it. And like I said, it's that educational flow there. Now, some general building blocks of a great structure. So there's a little bit of a review here. Tax, we want you to keep more of what you earn. Liability, we also want you to keep more of what you earn and keep it out of the hands of, professional plaintiffs. Unfortunately, we live in a world, and it didn't get much better with this whole COVID thing, where there are professional plaintiffs out there looking to put their hand in your pocket because they look at you as a real estate owner or property owner as somebody who has, and they look at themselves as somebody who doesn't have, and they think you should give them some of what you have. Now, never mind, you just had to replace an AC unit, or you had a vacancy, or it took you at this point over a year to evict somebody and weren't getting rent the whole time and they were racking up utility bills. That's not what they see. They see that you own something and they want part of it. So we want to protect against that from a liability perspective. Going along with that liability perspective is anonymity. It is hard to put a target on something you can't see. So we use anonymity in order to help prevent, or preventative medicine side of helping prevent lawsuits. I'll tell you anecdotally, when I speak with some of my law school colleagues, some that are working for personal injury firms, things like that, if they see a Wyoming or Nevada entity, there has been many times where they've said, we won't even go after it. It's just too expensive. Because the reality is, to take some of these assets, you would need to go to Wyoming, or if you're using Nevada, you'd have to go to Nevada. And that usually takes sitting with a Wyoming or Nevada attorney who's going to want to take half your fee for just sitting at the table with you. So, like I said, it's sort of understanding the motivation and removing some of that motivation along the way so that you're not an appealing target. Estate planning. Easiest piece we probably talked about. Get a living trust that avoids probate. Retirement investing. There's ways to invest with your IRA or 401k. There are some different strategies with both. 401k tends to be the preferred investing vehicle for those looking to invest in real estate. They'll go into more of that during the one-day class. There's some just tax considerations that are a little different between the two. So good to note there. And then business planning. Business planning is sort of a unique thing Anderson does, where we can help you put it all together, right? You tell us your goals. We look at tax and liability. We also look at where you're at in your investing career. What step are you on? And then we can help put together that business strategy for you. So if your goal is to look the most lendable as possible, you can accomplish that. If your goal is you're at a place where you've got enough income coming in, you're not super interested in the best tax strategies, you're just more interested in holding on to everything you got and letting it pay you till the clock runs out, we can help you with that too. So there's some different areas to look at, but everybody's business plan is going to be a little bit different. So what's next? Well, if you would like a immediate consultation and sort of skip that class, you're welcome to use this link here, which I think we'll share in the chat so everybody can just click on. This will schedule you. You can schedule for a free consultation, and we will go through and draw you up that blueprint. So just going to pull up the chat so I can see okay, the link is there. If you like what I'm talking about, but you feel like you need a little more information or more education, you can use this link to sign up for that one-day class where you can get that free information. And you will also get that, hold on one second, I'm just going to type it in here because I forgot to. You will also get that consultation afterwards, but that's more of, hey, I enjoyed the information, enjoyed the class. I want to hear more in detail about each of these things, and then you can have the consultation. And then finally, as a shameless plug for me, because I do have my own YouTube channel sort of under the Anderson umbrella, I would invite all of you, if you like the way I presented content or like the way I sort of break things down simply, the Coffee with Carl is my little YouTube site. And if you would like and subscribe, I would appreciate it. So now I'm going to hop into, let's take a look at some of the chat questions here, and I will go through that. I see Bola says inflation's killing you. Should be helping you. Got to get moving.
I think there's one, Carl, that says, would title companies extend title coverage or provide endorsements for LLCs or land trusts if the current title's under an individual's name?
So yeah, title companies, title insurance are all going to be a little bit different. We would suggest working with the insurer on that. Title companies themselves most times don't really care unless they are the insurer. So I would say work with the insurer. There's a bazillion properties out there that are owned by an LLC. So it's not a matter of if you can get title insurance, it's just finding one who's willing to work with you.
Mhm.
Let's see.
So I had an interesting thing happen to me. Of course, I have a LLC that was set up in 2018 for a property that's a development property.
Mm-hmm.
And I refinanced it in 2020. And I just received a notice from the Franchise Tax Board that they want to redo my tax return and call that refinance income. And they want to charge me $6,800.
They want to call the refinance, they want to call debt income.
Yeah. They said we have adjusted your return, and they did the refinance as a income.
Yeah. Welcome. I guess. Welcome to. I don't know how you would justify that because debt is not considered income
I know.
in anything.
I know. I'm curious how they felt like they could redo that, but yeah, and I'm running around trying to figure that out because, of course, we're trying to sell the property that's in this LLC that they have this against. So
That is so weird. Yeah, that's very weird.
yeah.
Because it's like, so you're telling me I don't have to pay my loan back and I just get to keep the money?
Oh, okay.
If that's the case, then fine. Here's your tax bucks. But yeah, I don't know. That one's weird.
Yeah. All right. If you have any questions, this is your last chance to get them in here. Carl's ready to answer. I don't know if you have any plumbers or handymen up in the Lake Tahoe area. There was somebody looking for that.
I don't. I work with a couple restaurant owners up there, but I don't have I don't have property in Lake Tahoe, so I guess I wouldn't be the one to ask for that one. Let's see. Yeah, so Anthony said it too. Appreciate the great info. I think I need to click on a link for a consult. It's one of those things. It's not it's not too good to be true. It is a free consultation, but also the class is free too if you just want more information.
And I will vouch for Carl because I have the platinum plan and he is my representative, and I'm telling you, great information like this every time I talk to him. So definitely worthwhile.
It's been a crazy, the COVID thing's been a crazy ride, but I've hired over the, last year and a half, I've hired an additional 20 attorneys. So we're not slowing down either. So yeah, we, like I said, we like helping people, like working on the preventative side. So yeah, great opportunity to, take advantage of a free consultation or free class. And like I said, if the information doesn't suit you, you don't like the strategies, that's okay. You are more than welcome to try it with somebody else too. Now, I've been a long time advocate of if you try it or do it yourself and then come back, that should be like more expensive, but the partners are against that. They don't want to disincentivize anybody from doing the right thing.
So we have a question from Lana saying, how do you structure tax returns to get a mortgage? I don't know if that's something you need to take offline or if that's something you can answer.
Structuring tax returns to get a mortgage is basically, certainly if you wanted an individualized idea, we'd need to talk offline. From a broader perspective, if you're working with a lender, they'll tell you what box you need to fit in, and then you sort of got to fit into it. So if it's being more, showing more income, then I would probably have a C corporation paying me a W-2, so I'm showing more income. If it's showing less debt or less debt to income, there's different things you can do. Like if you have a qualified retirement plan, you could always loan yourself money, pay down or pay off that, high interest credit debt or something that's hurting you. And that's how you do that. So really it's first step, have the lender draw the box, have them tell you what they want to see. Then you basically make the adjustments you need to fit inside that box.
Awesome. Bola says, what advice would you give someone new in this business as far as driving around looking at distressed properties?
It's easy to do. At some point though, you got to act. There's a lot of folks out there who are sort of happy to sit on the sideline or tell you how many good deals they passed up. At some point, if you want to get into the game, you got to get into the game.
Johanna says she received a refund from the state and then received a letter informing her that it's taxable.
Sounds about right for California.
Yeah.
So one thing to note, and if you go to our YouTube channels, we have some commentary on it as well. Some of the weird things that happened with COVID and the money that was being handed out, things like that. Some of that is being tinkered with, not only at the federal level, but at the state level. So some of it might be that. So some of it, I think they started to say, or California started to say, some of it is taxable as income unless X, Y, and Z. So you may just need to check the box for X, Y, and Z. But yeah, there was a lot of money given out during those lockdowns, and it's got to come back from somewhere.
Oh, crazy.
Hey, Carl, I have a question from Robert. Are there any problems having the same LLC as the land trust trustee and also as the beneficiary?
Yeah, trustees listed on title. So I wouldn't want my beneficiary listed on title or directly connected to what's easily seeable.
And then Russ is asking if you can share what the platinum plan includes, and do you draft docs or just tell us what to do?
So a platinum plan is basically the consulting side of what we do. So ultimately it's $35 a month. You can call in, speak to an attorney. There's written questions. We can review documents. A limitation on the document reviews we're going to look at it from sort of a 50-state perspective. We're not going to comment directly for state specific, but it's a nice little look over so that we can say, yeah, you know what, it's missing a severability clause, or yeah, this one looks pretty one-sided, or especially for those that are sort of new in investing. If say you've got a rental property and want us to take a look at the management agreement, that's a good thing to look at. Those, by the way, are always pretty much one-sided, but it bears to mention and look at because there can be some things tucked in, like, maybe the person you're working with or whoever's the manager is also committed to taking a commission if you sell the property, things like that. So that's the idea. Like I said, it's part of that preventative medicine side. It's the consulting side. As far as drafting docs, yes, we draft if we set up an entity for you, we're going to take care of drafting the bylaws if it's a corporation, partnership agreement if it's a limited partnership, and operating agreement if it's an LLC. By way of sort of explaining the standard side of what we do versus what you see online, from say a LegalZoom, InkFile, something like that. A lot of times the operating agreements are going to be somewhere in the, 9 to 12 page range. The stuff we put out, by the time all the ancillary documents and everything are included, it's usually around 100 pages. So not just because we like to type or hear ourselves talk, but because those agreements are intended to address things, to tell a third party how to decide different conflicts or issues if such an issue arises. So idea being is if a judge is reading the operating agreement that you and your partner signed, ultimately that agreement should tell him how to decide that case, him or her, how to decide that case, instead of just a sort of good argument, I suppose. So yeah, words matter. Let's see. I see a question from.
So we have
Catherine.
Catherine. Yep, you want to do that one?
What entity would I suggest when purely using for passive syndication investment? So entity I would suggest using for a passive syndication investment. I'm not concerned in a syndication investment about inside liability, because usually if I'm investing in a syndication, I'm investing in a business entity that's holding, title to the property or holding the funds. So I'm not necessarily worried about what's happening on the property. What I'm concerned about from my investment perspective is that outside liability, because I don't want somebody to be able to take my investment or the payouts from my investment from me if there is that, car accident or individual liability thing. For most people, for a syndication investment, the most common suggestion is use a Wyoming LLC. It's private, it is protected, and it basically works like a super secret and safe savings account. So I guess that would be my suggestion. I would use the Wyoming LLC there. That being said, if I'm doing a variety of passive investments, I may choose to have a Wyoming LLC that owns a Wyoming LLC that's holding my syndication investments. Then I may have another LLC that's holding my brokerage account, and then may have another one that's holding my crypto account, depending on the value. So some dialing in there, but yes, there's some options out there to make sure you're not only looking at the inside protection, but outside protection to hold that investment long term. Is there a limit on consults per month in the Platinum plan? Oh, that's a question that makes me nervous to answer. There's not. So of course, if we find, Russ, I don't think you would abuse it or anything, but of course we always reserve the right if there's somebody who's being abusive of the plan. However, I think I could probably count on one hand the people I've had to sort of slap on the hand for doing that. No, we don't limit our access. We want you to access. We want you to utilize it. So no, there is no limit. However, between the large group of attorneys at this point, you will gain a reputation for being a frequent flyer if you're on there every day. Let's see. Do I recommend a C-Corp or I think S-Corp for operating a residential care facility? What entity should hold the facility property? So normally if I'm setting up a residential assisted living facility, certainly things are important, like do you have partners, what state's it in, things like that. Generally what I'm looking at is I would hold the real estate like I would a rental property. So normally that means a state-specific LLC owned by a Wyoming LLC. To throw in the California twist, it could be a Wyoming statutory trust with the beneficiary being a Wyoming holding company. And then to run the active business, I would lease that property usually to something with S-corporation status, depending on what your overall goal is with the income generated on that assisted living facility. So basic concept, keeping the valuable asset, the real estate, separate from the active business. Do we have a minimum asset requirement? No, you can be identifying your first property, or you can be identifying your 100th property. If you want to work with us, we will find you a way to work with us, even if it's just the informational side. Even if you just want to ask us questions because questions make you happy.
You're funny. Okay, well, I think that ends tonight. Oh, one more time for the sign up.
So is there a one-time sign-up fee in addition to the monthly fee? If you're going the platinum only route, there is a one-time sign-up fee. It's not annual. For the most part, most of our clients at this time, the best offer to start out as a client, and it includes a business entity, comes from that one-day class. And they'll usually, in that sign-up fee is usually included in that offer and waived. So I would say if you're interested in becoming a client, like I said, number one is you could do that free consultation. The other route is to sign up for the class, and there's a ready-made offer called our Business Essentials offer, or sort of our starter pack, where you get that platinum membership included in that. Let's see. Can a Wyoming LLC Hold, another S-Corp, not LLC. Okay, so technically, Catherine, a disregarded LLC can own an S corporation. When you go to file it like that with the IRS, though, it sort of causes them to blow a circuit because there's restrictions on who or what can own an S corporation. So could it? Technically, yes. Is it practical, or does it work that way directly? It's usually not quite that straightforward. You're better off just having them completely separate. So ultimately what would happen long-term is you would have the shares of the S corporation held by your living trust, and you would have the membership of the Wyoming LLC held by your living trust. And that takes care of the estate planning portion of what you're doing. But yeah, otherwise the IRS, technically you can do it according to the IRS. They just don't really know how to look at it because a disregarded LLC to them, or a sole proprietor LLC to them, doesn't exist. So it just sort of looks like, from a tax side, you own it. Oh, good question here too. Another beginner here. At what point would you recommend some kind of business structure over umbrella liability insurance for asset protection? Anthony, good question. I'll just tell you, from sort of personal experience and working with clients over the years, insurance is great. Everybody should have insurance. However, if you look at your policy, it's usually about 1 page of coverage and about 100 pages of what's excluded. So the point where you say, when is an LLC appropriate, is, I guess, just from an investor standpoint, is number one, does the asset or the cash flow support creating an LLC? The other thing is you also factor in, what did it take you to get to this point where you could afford that asset? And is that worth protecting? So I've seen people start an LLC with property one and just saying, hey, I want to build off of a firm foundation here. Let's start that way. From a practical standpoint, I kind of like starting it outright and building off of a firm foundation. However, I do think there is some logic or an argument that, hey, maybe I have 2 properties or 3 properties before I put it all together. So it's a little bit different than for everybody. However, for the most part, if it's something you think it's worth protecting, then it should be in an LLC. Let's see. Is there a rough dollar amount?
Getting some good questions here, Carl. I can't wait to hear this next one.
Okay. Is there a rough dollar amount in assets or number of properties which you'd set up a business structure? I'll tell you my default, I guess my own personal default would be usually when you have, for a passive side of your structure, I would tend to look at about 3 properties before I say, let's go with Wyoming Holding Company, individual LLCs. But like I said, that's sort of a personal preference, not a hard and fast rule. I've heard umbrella liability insurance is sufficient for early stage investing when you don't have a significant amount of assets. Yeah, as long as it covers you. The problem is, especially if you're partnering with people doing other things, a lot of times those are excluded in insurance policies. So the other piece would be, I would suggest you definitely go to that 1-day class, because there's a whole slide on what insurance traditionally doesn't cover that you should be considering as well. All right, from, I think it's Rachel or Rochelle. Either way, we're going to answer your question here. If I heard it right, you suggest leasing an active asset into a business entity you own. For example, leasing a short-term rental that you own to an LLC that you own. Sort of. So short-term rentals are a little bit different because the tax code defines them as a little bit different. If you're a tax dork and really like reading tax publications, it's one of those things that got seared in my mind at some point. But IRS publication 925 will take you through the rules of short-term rental and when it generates active income subject to self-employment tax versus basically when it's treated like a regular rental. From a liability perspective, we'll always treat it like it's a regular rental. So state-specific LLC owned by that Wyoming holding company. The piece you're touching on is the one that takes some analysis on, do we need to try to shift some of that active income to passive? And then if we do, there are some options there using a term that's probably most familiar with commercial investors, but using a master lease can help us shift some of that income. So short-term rentals are cool, but they do take an extra layer of analysis, because at some point the hotel lobby said, hey, these guys are doing hotel stuff too. They should be paying active income. Let's see. How often do entity structures set up by Anderson get pierced? I'm not aware of it ever happening. So some of it, we can go into I guess, some of the details here. Number one is when you get sued, it's most likely to settle at some point. So also we tend to qualify our clients who we're working with, and really your sort of one immediate way of piercing the entity is fraud. And so if we sort of sense that in you, we're not interested in working with you. So we sort of pre-screen some of those folks that are probably also most likely to be subject to that. So I don't know of a case that the entity structure has been pierced. I certainly know of lawsuits happening and some of those inside liability issues that have turned into knockdown, drag out fights, but I haven't seen where they've pierced into the holding company and we're sort of able to raid the treasure chest, if you will. Let's see. Do you suggest anything special for assets held in an IRA, or is IRA its own protection since you don't own the IRA custodian? Yeah, if you set up your IRA in California, your IRA is not protected. So California doesn't protect IRAs or Roth IRAs. So just as a heads up there. Anything special for them? Normally, if I'm holding real estate in an IRA, like a rental property, I would set up an LLC owned by the IRA. So you treat it as an alternative, I guess, sort of investing hub from our structure examples there. When and how would personal property trust be used? Catherine, I would do it as needed. So I would have if you're interested, I would have a consult. It's not for everyone. Quite frankly, there's a period of time where it was pretty much set up where everybody wanted one for their brokerage account, but really it's pretty narrow set of circumstance where you need one. Most brokerage houses or decent sized brokerage houses don't care if you're trading in an LLC at this point. It's the day trading with the live data feeds that tend to, I guess, trigger the need to use one. So most people don't need one at this point.
Okay, last call. This is it, guys. We're just about to wrap up.
And I wish I was drinking something more interesting. It's just my nightly kombucha. So.
Okay, Carl. Thank you so much for all the information. It's amazing. I hope that all of the listeners will reach out to you and take you up on your free offer, because quite honestly, the amount of education you guys share is phenomenal. So I appreciate you. And
yeah, thank you so much for having me. And I look forward to, working with everybody once you become a client. Usually, like I said, appreciate the coming to the class. If at some point I hope to earn your business. So if we can help you with the education, always happy.
Awesome. Thanks, Carl. Good night, everyone. We'll see you next month.